Welcome to the NAIFA webinar series, providing you with timely information and training on topics of interest. This is Brendan Burnett, Director, Professional Development and Education Programs. Today we are presenting Income Protection, Disability Insurance Encyclopedia. With me today is Larry Schneider. Larry is a disability insurance specialist with over 45 years of hands-on experience, exclusively specializing in disability insurance. Over the years, over 50 DI-related articles have been published in many of the trade magazines, including NAHU, Forensic Examiner, and Kiplinger. And Mr. Schneider has lectured to many of the nation's leading associations, including CPA Association, and has appeared on television explaining the many contractual differences between policies offered by the insurance industry, as well as being a panelist for a litigation conference. In addition, he is an expert witness and consultant for DI claims, which have been inappropriately denied, and a national resource for hard-to-place insurance applicants, as well as a national source for application of business and individual standard cases. He has also authored a nationally acclaimed training manual called the Encyclopedia of Disability Income Insurance and the Anatomy of Denied Disability Insurance Claims manual, and this is used by many attorneys. He has also helped the American College substantially rewrite their Essentials of Disability Income Insurance manual and has been a guest speaker at the MDRT 2013 convention. And he has also participated in many webinars, including the webinar that NAIFA is hosting today. We are thrilled to have Larry Schneider with us. Prior to his insurance career, he headed up a department for one of the big 8 CPA firms, and he was performing analytical studies on behalf of their clients. And we are, of course, wrapping up Disability Insurance Awareness Month here in May. And so today, Larry will explain the many compelling reasons to offer DI coverage to existing clients. During the webinar, you will learn all the major components of disability insurance, both for individual and business applications, the reasons for selling DI, tax consequences related to DI plans, split dollar, key man/person and buy-sell plans, and sales opportunities for individual disability plans as a supplement to group long-term DI plans. During the webinar, you may type your questions in the question box on the right side of your screen. This webinar is being recorded, and following the webinar, you will be emailed a web link that will allow you to access the webinar recording. And I can also add, in response to a question regarding CE credits, this webinar is approved in many states for CE credits, and instructions will be forthcoming as to what you need to do, but for the time being, simply sit back and actively participate in the webinar to fulfill your CE credit obligation. And with that, I will turn the webinar over to Larry Schneider.
Just keep talking. Hello, everybody. As you heard a little bit about my background, and I hope to share much or as much as possible of my experiences and knowledge with you today. I realize we may have a mixed crowd, meaning some people know a lot about disability insurance, other of you may know a little bit, and then there will be many others right in the middle. So I'm going to take the middle road and just go over some basics before we actually get into the presentation. Another thing you may have noticed, and I'm going to try to slow down, coming from New York, I talk a little bit faster than I probably should in these kind of things. So I want to mention up front that if at any point in the future, after the webinar is over, you want to call me and get some information that I glossed over or didn't go into as much detail as you would have liked me to have done, I'll be more than glad to take your phone calls individually. You could also send me an email, you know, whatever. So the webinar will extend beyond today's broadcast, so to speak. But just to go over a couple of things, and we're going to stay on the first page just for a minute. I want to give everybody a little bit background on some terminology which might help you in the future. This has nothing to do with sales per se or finding out why one of your clients should have one form of disability insurance or another. But in most individual policies, and initially we're just going to be talking about individual policies, there's a clause where they define sickness. It's important to realize that some companies use the word manifest versus contracted. contract is the, manifest is the best one simply because if somebody contracted cancer, for example, 4 or 5 years later, and it caused a disability, the insurance department, the claims department, may consider that as a pre-existing condition, where if it's manifest, that means when it first appeared, which is much better. Guaranteed renewable, you've heard of that before, and non-cancelable. Guaranteed renewable means what it says. It can be renewed, but the premium can be increased, not on an individual basis like automobile insurance perhaps, but if the rates go up, it has to go up for all people in a certain state that's being contested for a certain classification. So if it's a classification 3, it doesn't necessarily mean it's going to go up for classification 4. Elimination period, for your information, there are 2 types of elimination periods. One is that the elimination period has to be continuous, meaning if somebody thinks they've recovered to a certain extent and they go back to work and then they get a relapse, the elimination period, the clock gets reset and they have to start all over again. Some carriers use what I call a stop and go, meaning there can be interruptions. This can be important. It's what they call presumptive disability, and I'll give you the definition of presumptive. That means even though you've lost an arm and a leg and still working in your occupation, which suggests if you can, you're really not disabled, some companies use that the condition must be irrevocable. Other companies use that it just happens for a period of time, like 2 broken arms. So if somebody gets 2 broken arms in skiing, they go into the presumptive disability clause, which means even though they're working in their occupation, from day 1, they'll be paid their monthly benefit. All right, now we're going to get into the presentation itself, and I'm going to advance a slide. Disability insurance means what the slide says. I'm not going to waste a lot of time in things you could read or aren't really significantly important. Okay. Why sell or recommend, if you're fee-based, disability insurance? There's about 10 major reasons there. One is you want to protect your client by all means. Number 2, from a selfish point of view, I often think about, do I want somebody else coming in behind me talking about disability insurance where I haven't brought it up? That would be at the very least a little bit embarrassing and possibly result in a loss of a client. But in this particular page, there are 10 reasons, and I think, again, you'll get a copy of the presentation if you like, so you could study everything in more detail that we're presenting. Okay. Why sell disability insurance? For those who are on commission, it's a very, very healthy way to develop an annuity. If you only sold $10,000 worth of premium the first year, typically the commission is 50%, and that means that, and the average premium, let's say, could be $4,000. So it's 2.5 applications in a year, which isn't very much. So you're getting at 50%, $5,000 in commission, plus in the second year on that block of business, you get another 10% on top of that. And if you continue only to sell 10,000 in the second year, you're getting 11, and so on and so forth. So I think the numbers will speak for themselves without dwelling too much time on this. Now, why isn't it sold? Rejected applications, your fear of applications, the fear of an exclusion or rating, the fear of losing a sale, of not being able to rebut an objection, and getting back to the Encyclopedia of Disability Insurance, it'll address all of these things so that everybody could become an overnight expert with a minimum of time investment. But I want to dwell on number 3 for a minute, the fear and exclusion rating. Even though there's an exclusion on, let's say, a bad back, what will still be paid, even with the exclusion, if there's a fracture involved, because that has nothing to do with a pre-existing condition. A fracture is still a fracture. Just want to throw that in as a little piece of information that might help you later on if there's an exclusion. Okay? As far as, protecting somebody's income, at age 25, only earning $2,000 a month, to age 65, that would be close to $1 million, $960,000. and the chart shows, you know, what the incomes are for each what the different incomes could be, and the projection how much they have to lose that given different ages. Okay. Now, how often does disability occur? Well, I could tell you this: it's 16 times more likely than death to cause a foreclosure. Okay, and on this page it shows the different percentages, what the causes might be, both for death and disability, as far as showing it to you in a comparison form. How likely is a disability at different ages? At age 30, we tend to take a little bit more risk, okay, so that is a higher propensity of claims when you're at age 30. As you get to the other end of the chart, where it shows age 55, you're a little bit more conservative in some of the things you're doing. You're not trying to speed up and outrun a speeding locomotive or do anything crazy like that. But sicknesses and illnesses are more predominant the older you get. But disability insurance covers both accident and sickness, and typically in an individual policy, it could be paid to age 65, 67, or 70. Obviously, the longer the benefit period, the higher the aggregate amount of the benefit would be. And obviously, the premium would be that much higher as well. There are other benefit periods in case, you know, budget is a concern. There's a 2-year benefit period. There's a 5-year benefit period, a 10-year benefit period, and the ones I just mentioned. Now, what are some opportunities in presenting and earning a fee or earning a commission in disability insurance? Well, there could be selling individual disability insurance, which on the average could cost between 2 and 4% of somebody's income. And if they're self-employed, that would be their net income rather than their sales. So it's a big difference. In group, it just depends the average age of the group and what some of the configurations are that are built into the group, such as the cap, what percentage of income is covered, and some options and things like that. You could always supplement the group because, as I mentioned earlier, group disability insurance is taxable. So if it is taxable, which means the employer has paid the premium, then you could give a supplement to replace the taxable amount. As far as another product is concerned in the disability insurance marketplace is a business overhead policy, which means in addition to the ones I just mentioned, there could be another policy which takes care of the business expenses of a company, including salaries. Key person, if you have a rainmaker in the company that's producing, let's say the sales manager, and you want to put a policy on that person, it's called a key person policy, just like a disability policy, but the benefits go to the company or the owner of the policy. Here's one that I like a lot, especially if there's a partnership. Excuse me. It's a buy-sell product, which means if the partnership has an agreement that they're going to be bought out due to a death or disability, obviously it should be funded by a disability policy. Split dollar, that's a creative way of making the premium affordable both to the company and the individual, which means, for example, if the monthly benefit can be $5,000, but neither one means the company or the individual has the proceeds or the money to spend on the premium, the company could pay the premium for $2,500 of the total amount, and the individual can pay the premium for the other $2,500. Now, when there's a claim, the first $2,500 paid by the employer will be taxable. The other $2,500 will be tax-free. Then there's a product which takes care of retirement. There's another product which takes care of loan indemnification. In case you're a business owner, you've taken out a big loan. That's a separate policy on top of everything else we just mentioned. And of course, if they've been turned down, there's places, and my company specializes in hard to place, and some of the reasons you could be turned down for disability is a serious health problem, age, meaning over age 60, not enough income, occupation, for example, like a roofer or a deep sea diver, or any number of reasons. And another reason could be just started a new business, okay? Now, let's take a look at group disability, okay? One of the many problems, of which there are 22 problems, and I could send you a list of all 22, is that unilaterally the coverage could be canceled any time by the insurer. Rates could be increased, which, contrary to individual insurance, the rates are guaranteed. Usually and many times, certain forms of income, such as bonuses and owners' pension contributions, are typically excluded from coverage. So if somebody's in the sales department and they're getting a large amount of their income stemming from bonuses or commissions, that may not be covered by disability insurance. And again, if that happens, a supplement plan could come in to take care of that form of income. Benefits, there's lots of offsets in a group disability policy. For example, benefits are reduced by Social Security, workman's compensation, and possibly early retirement plans you may be forced to take, and sometimes rare other disability insurance, individual. Mental and nervous, typically, and I say typically 99% of the time, only will pay for 24 months. And again, on the individual side, some companies will treat it like any other sickness, which means it'll be paid for the full benefit period. Other companies might say just for 5 years and so on. You could custom-made coverage to the particular needs is generally restricted in a group disability policy, meaning the elimination period, how much coverage will be paid out, which is the cap, and so on. Individual coverage eliminates all those problems. Okay? Forgetting plan distribution, that's another one. But definition of total disability, and I'm going to be talking about the different definitions in a few minutes, but in the definition of total disability in group plan is usually pretty restrictive. It could be from day one or after a certain period of time, which means that even though the benefit period has been stated that somebody will be paid to 65, typically after 2 years, typically I say, not all the time, could be 5 years, the definition changes to a very restrictive definition, and I'll give you the definition now: unable to do the duties of your occupation and not working elsewhere or unable to work elsewhere, whereas individual plans typically do not have those restrictive definitions. And I say typically, if the individual that has individual insurance is a clerical type, they may not get the good definition that I just described. Bonuses are typically not covered, again, creating a coverage amount shortfall. The wording in the contract, and the contract is between the owner of the business and the insurance company. The individuals who are covered by group disability insurance only get a certificate. So the rates could be increased, and the wording and the contract can be changed. And it's not guaranteed, which means, again, it could be canceled and taken away. Okay? Renewability, as I just mentioned, it's not guaranteed. Claims, because it falls under ERISA. Acts of bad faith are not discouraged, meaning due to ERISA, the spelling misspelled there, it should be ERISA with an A. The individuals can sue for punitive damages, and therefore the claim could drag on and on and on and on. Claims can only be submitted while working, and coverage is enforced rather than something happening after the coverage being canceled, or the employee or the whoever leaves the company. Pre-existing conditions may create an unanticipated problem at claim time. I think we could skip some of these things which are self-evident and go to the comparison between individual and association. Association and group are fairly similar. There are a couple of differences, as the chart has demonstrated, and on the third column where it talks about the differences between this group and association, the individual side has rarely any of the problems that group or association plans have. And I've listed all the criteria for the analysis. Okay, we could go to another one. Now, how does group insurance discriminate against high-paid executives? And I'm going to call that reverse discrimination. Simply stated, if the cap is $5,000 a month, and somebody is earning, for example, $50,000, and the benefit amount is 60%. Well, 60% of 100,000 or 50,000 is 2,500. So they're certainly under the cap. No discrimination yet. If somebody's making 100,000 and they get 60%, that's 5,000 a month based on the cap being 5,000 and they're earning 100,000. But what happens if somebody's making $200,000 a year? Here's where reverse discrimination rears its ugly head. At 60%, they should have gotten 10,000. But if the cap is 5,000, which dictates and governs how much they're going to collect, then they're only collecting 30% rather than the 60%. And there's another sidebar there showing what happens with 300,000. So reverse discrimination happens when you have highly compensated executives and the cap is not tuned in to what they're making. If it were, then many of the people, the premium would be excessively high because the higher cap would apply to the majority of the workers. It would only apply to the executives. So that's a good thing to point out to highly compensated employees of a company where they could get a supplement to replace or to overcome the reverse discrimination that I just described, okay? Now, this just in writing and black and white, so to speak, talks about the reverse discrimination that I just talked about. It gives all the examples, and especially when it's an employee-paid premium, okay? The solutions, like I mentioned, individual-paid individual insurance, benefits under the individual are paid tax-free. Now, there's a couple ways to do it. It could be an executive bonus, which is IRS Section 162, which means the company could give a bonus, a higher income to the executive. What happens then, if they get the bonus, then that's going to be taxable income. There are other ways to get around it, such as split dollar, where the supplement can be 50% paid by the employer, where part of it will be taxable, and the remainder by the employee after getting the Section 162 bonus. Combination summary. Rather than dwelling a lot of time on this, I'm going to pass a little bit and let you study the charts so that if we can move on. On this chart, the same thing, I'm going to pass it a little bit long. It gives different configurations as to how much somebody could get with and without group insurance, how much they could get getting a supplement, and so on, okay? Now, there's three different results. Three key employees could be three different companies, makes no difference, become permanently disabled with three different results based on three different options. One is a typical business plan, which is an ad hoc kind of thing. They could get more income from the employer to pay for some disability insurance before they get disabled. There's the executive bonus plan, which we talked about, and the employer-paid premium. Going to move along on this one here because it gets a little complicated, and this is a continuation of the previous chart. Another big application is business applications of disability insurance and the related tax consequences. What we could do with the business application of disability insurance is a lot, okay? There's wage continuation plans, there's individual plans, there's business overhead expense plans, key man person plans, buy-sell plans, and in buy-sell we're going to be talking about entity, funded by entity systems as opposed to cross-purchase systems. In wage continuation plans, the purpose of that is to provide income for lost wages when an employee is disabled. The premium is tax deductible to an employee and not reported as taxable income to the employer, and not reported as taxable income to the employee. However, the benefits become taxable to the employee when there's a payment as a result of a claim. Questions and answers, I'll leave this to everybody's discretion, how they want to read this. There are certain rules that when there's a wage continuation plan, it has to be put into the minutes, et cetera, et cetera. It becomes a little bit more formal. And this is a continuation of what the wage continuation plan is. FASB is a government accounting standards board ruling, which, again, I'll let you read everything there. It's a fact of life, but you can get around FASB as this little chart will indicate, okay? Split dollar. Here's a couple of examples what could be split. The benefit period could be split, meaning that the employer could pay the premium as if it were a 2-year benefit period, and if the employee wants the benefit period to go to age 65, they will be responsible for the premium that goes beyond the cost for the 2-year plan. So for the 2-year plan, if the employer is paying the premium, then the benefits are going to be taxable. Thereafter, if they're still disabled, the benefits will be tax-free to age 65. The benefit amount could be split. Certain portions of the amount could be paid by the employer, the balance by the employee. The elimination period can be split as well. For example, if the employer will say, I'll pay the premium as if it was a 30-day deductible, and if you want the 30-day deductible, and so for the first 30 days, if there's a payment made, then the benefits will be taxable. The employee will pay the premium for any elimination period beyond that. And this is an easy one. The employer could pay for all or none of the options, or the employee, I hope I said the employer, by the way, or the employee could pay for any one of those options, and there are more options than COLA, residual. There's a future increase option, there's an automatic benefit increase, there's student loan, there's retirement, there's indemnification. Now, as far as individual plans are concerned, to replace lost net income, and for a self-employed person, they don't get a W-2, as you know, they get a 1099. An employee who works for a company will get a W-2, and what the industry insures with the employee that works for a company and gets a W-2 is their gross income, whereas for self-employed people, it's only the net profit which comes off the Schedule C profit and loss statement. The premium is not tax deductible, and as a result, the contra side of the coin allows the benefits to be tax-free, and the Internal Revenue Code on that one is 104, paren A, paren 3. Okay? Business overhead expense. A lot of companies will suffer, especially if it's a small company like, let's say, a law firm or an architectural firm or CPA firm, where they don't have 40 or 50 people working for them, like your association does, but it's a small firm, but they have a high overhead, nice office, salaries, electricity, et cetera, et cetera. A business overhead plan, separately from any individual plan, will pay for all the business expenses. And the purpose of that policy is to provide source of allowable expense income when an owner is disabled. The premium is tax deductible. The benefits will be taxed, but as the expenses are paid, it washes out the taxable benefit because of IRC 162. So it becomes a wash. Overall, they're ahead, by the way, okay? Who are your target clients? Small business owners, like I just mentioned, like a CPA, an attorney, architects, you know, anybody that typically is a small business. Business has to be in business or established for a minimum of 2 years. Minimum ownership in the business has to be at least 10%. It can't be just any worker. And there has to be a net income of the business of at least $25,000. Now, different companies, by the way, generally follow everything that I've just said, but different companies will have different protocols and different standards for everything we've been talking about. There isn't one size that will fit all, by the way. Okay? Again, these are some examples of who your prospects are, and all other occupations other than a blue collar, even though there's some exceptions there, are eligible for a business overhead expense. Okay? Some of the features, it's guaranteed renewable, non-cancelable, just like most individual policies are. Different elimination periods. The shorter the elimination period, the higher the cost. And what you could do in some cases, you could customize it. Let's say if the business overhead is $10,000 a month as far as the benefit is concerned. What I've done sometimes, I make $5,000 with a 30-day deductible and $5,000 with a 90-day deductible. At least there'll be some income coming in shortly after the elimination period is over. The benefit periods are no longer than 24 months. Can be as little as 12 months, and again, the shorter the benefit period, the lower the cost. Benefit amounts, actually, they go from $1,000, and some companies could even be much more than $40,000. The premium is tax deductible, the benefits are taxable, and when the expenses are paid, that's another deduction. So like I mentioned before, it's a wash. I want to point out that in order to get, and this is a reimbursement program, in order to get paid, an invoice has to be submitted to prove that that expense was valid. Okay? It'll also do replacement expense. For example, like a dentist, instead of losing his clientele and in the middle of a procedure, he could bring in a peer that will take over his office or her office for a period of time, and it'll pay that particular salary in addition to the salaries of the office. Is the definition of disability ONOC? And we're going to get into the different definitions in a few minutes. The answer is yes. And carryover, that means if the monthly benefit was, let's say, $10,000, and in that given month they only paid out $1,000, is there a carryover? Yes. Another option built into the business overhead is residual. Residual in all policies, whether it be the business overhead, individual, or a group, I'm going to give the definition of residual. Somebody who has a loss of income as a result of still working, they're not totally disabled, they're still working in their occupation, but instead of working 5 days a week and getting paid whatever they were paid, they could only work 3 days a week because of, for example, a bad back. And if they're out Tuesday and Thursday, that's 40%, all things being equal, of the week, then they get paid 40% of the monthly benefit. A future increase option allows the monthly benefit in all your policies to be increased without any evidence of insurability. Just all you have to do is prove that there's a higher income and you had an option which allows the monthly benefit to be increased. Key man, that's very similar to an individual policy. It takes care of your rainmaker to reimburse the owner of a business to offset expenses when hiring a replacement for a disabled key person or income for previously generated by a key person. The income from the policy goes to the owner of the business. The premium is not tax deductible. It's a discretionary kind of product, and therefore the benefits, when they're paid out, will become tax-free. Okay, this one I like a lot, and it's good for a partnership and a small company, again, CPAs, attorneys, whoever. Will your partner's new hobby cost you $1 million? In many cases, a lot of businesses have a buy-sell agreement funded by disability. For some reason, that's the word of the month. Life insurance will fund anything that could happen, but they don't have a buy-sell agreement that's been funded by disability, which they should, in my opinion. And it's a great door opener. Very few agents and financial planners will offer it or even talk about it, so that I think it's extremely important. And the advantages to the healthy owner, eventually the healthy owner will maintain 100% ownership in the business, smooth transition of interest because of the conditions of the buyout, and the firm's condition of existence is assured and the profits will not be depleted. And of course, the balance sheet, assuming they would have paid it out of their bank account, their balance sheet will not be depleted. And replacement proceeds are usually received by the disabled partner tax-free. The advantages to the disabled owner: he is assured of a buyer of a predetermined and fair price. He receives cash for his share of the business. There's freedom from the risk of future company losses, which means if it were going to be paid from the cash account, they don't have to worry about the company having a serious financial loss, and therein means they won't get paid as they expected. I hate to say this, but family members won't have to become involved. Many times the healthy owner doesn't want to become partner with the wife of the business, or the healthy partner, if it is a wife, doesn't want to become partners with the husband of the disabled partner. So it works both ways. The purpose of a buy-sell plan is obviously to provide funds to the non-disabled person in order that the disabled partners may receive a sum for their shares, premium not tax deductible, benefits tax-free. And usually the trigger date is 12 months, meaning that you don't want to kick your partner out and take over his shares if they're only going to be out for a couple of months.
And we're going to pause for one moment in order to launch a brief poll. The question was asked earlier regarding CE credits, and in order to receive CE credits in certain states, it is required that you actively affirm that you are participating on the webinar. So I have now launched the poll, and if you are participating on the webinar, if you'll please just go ahead and indicate yes, and we'll leave the poll open for a few more moments so that you can go ahead and again indicate yes if you are right now with us on the webinar. And for some states to receive your CE credits, you are required to affirm your participation with a yes polling answer. And we're going to keep this poll open for about another 20 seconds to make sure all of you have had a chance to reply yes. And we are now going to go ahead and close the poll and continue with the webinar. Thank you so much for your participation. And now back to the webinar.
Okay. We're going to skip this particular slide and talk about the tax facts, which are self-evident. I'm going to skip over some of the next charts to leave the remaining time, which I think is about roughly 20 minutes, open for questions. If the questions get depleted, then we'll go back to some of the slides. But one thing I want to mention, despite what you might have been told or believe, buy-sell agreements funded by disability, the disability policy is not guaranteed renewable, which means, let's say if the business at the time the policy is taken out is worth $1 million and the buyout amount is $500,000. At the time of claim, if the business is only worth $100,000, the buyout amount is not what was originally contracted for. It would be reevaluated. I know that sounds terrible, but that's the way it works, okay? So I'm going to turn it over now to the listeners, see what questions they may have, and I'll do my best to answer them.
Great. Thank you very much, Larry. And as a reminder, if you would like to ask a question, you can type the question in the question box on the right side of your screen. And I will go ahead and address our initial question, which was any special instructions to ensure that CE credit is received. And the answer is that if you are in a state in which CE credits have been received for this webinar, by responding to the polling question and attending the webinar, that's all you need to do. NAIFA National staff will handle the reporting with your state executive, your state association, so that you can receive CE credits for the webinar. The next question, do most companies have the same requirements as to income required?
Yes, those are industry standards, and income required, if I understand your question, is proof of income. And if I don't answer your question, I'll certainly try again. But proof of income, if they're an employee, a W-2 from the most recent year, and 2 consecutive pay stubs. If they're self-employed, then they're going to need a tax return. because they don't get a W-2, obviously, and the tax return will show off a Schedule C profit and loss statement the net profit, which is the most important thing when determining how much a self-employed person could get.
Okay. Thought this would, what percentage of buy-sell agreements completely ignore disability?
I can't answer that. I can only answer those that, I mean, it's the converse of your question. There aren't that many businesses that take out a buy-sell funded by disability, mainly because they haven't been approached either by the agent or the financial planner. But and I can't give you an exact number. Some of the insurance companies keep that kind of information close to the hilt. But there's enough because they spend a lot of money in promoting it wherever possible and coming out with educational material. So I think it's profitable.
Will the slides be available for review, and how can they be obtained? Well, first of all, everyone who registered for the webinar will receive an email with a link to the webinar recording, so you'll be able to watch the webinar. In addition, Larry Schneider has generously offered to make the slides themselves available, and so if you'd like to see the slides themselves in addition to the webinar recording, simply send me an email, and I'd be happy to provide the slides to you. I will slow down and read my email address, so if you're one of the people who would like the slides, send an email to bbernat@nafa.org. That's BBERNAT@nafa.org. And I will certainly provide the slides to you. The next question, I assume that if the disability buyout is for less than the original premium amount is refunded.
No.
All right, so the answer is no if the disability buyout is for less than the original premium.
Right. Okay. Good question. I knew that was going to come up.
And someone had difficulty accessing the poll, but they're here, so thank you very much. I'll be happy to mark you present based on your question. So one question that we also had was regarding, you know, if your practice is heavily involved in life or money management, but you've never gotten into DI before. What are some ways that you can really launch your DI practice and really market this? Any helpful hints on that?
Well, one of the ways is through the Encyclopedia of Disability Insurance. It's about 3 inches thick, 2 volumes, front page, back page, and what's left of my brain, I did a brain dump from everything that I know, from prospecting to rebuttals to how to construct a plan, and it includes all 50 of my articles and much, much more. So it will make you an overnight expert. But beyond that, there are various associations you could join besides the one you belong to that talk about disability insurance. There's trade magazines you could subscribe to. There's sources. There are other manuals of other companies that have produced manuals, like the American College, even though I was heavily involved in rewriting their manuals, so my little encyclopedia hopefully is a little bit more informative. Not that I jinxed theirs, but those are some of the outside sources that you could use to become more proficient in disability insurance. One other thing I want to mention, getting to the buy-sell, which the chart may not have mentioned, 99% of the carriers who offer buy-sell agreements funded by disability, and there aren't that many, maybe 4 or 5 out of the 13 carriers that remain. At age 60, the benefit amount automatically will go down by 20% without a reduction in premium. Okay, and I'm pretty sure about the last part, without a reduction in premium. I'm vacillating on that one because they're dictating that the original benefit amount is going down. It may be that the premium will go down as well, but maybe not. I will double check, and if I hear from somebody, I certainly will have the answer to that. And one thing, even though Brendan announced about the slide, in my mind, the slides were not physical slides, but the presentation. Okay, just want to make sure that the expectations are real.
Sure. And I have provided my email address in the chat to the entire audience. which was bburnett@nefa.org, if you'd like to see that again. And if you're interested in the DI Encyclopedia that Larry was mentioning, I have also provided his email address in the chat to everyone participating, which is info@di-resource-center.com. Question on the CE credits for today. In any states that the webinar was approved for CE credits, that is approved for 1 CE credit. Next question, can a key person have their own personal DI policy and the company own a key person DI policy on the same person? So in effect, it double up on the benefit paid by insurance company for one disability, or must it be an either or choice to insure?
Usually an either or, and the reason for that is when it could, let's say if it weren't an either or, let's say they could get both, at some point in time, if the owner changed back to the employee, then as the question asked, they would have double the amount of coverage they could normally get. So the answer is normally, and I always say normally, no.
Okay. I am a disabled partner and my company goes defunct after I have become disabled. Do I still receive my payment?
If it's a group plan, absolutely. As long as the claim took place while the policy is in force, even the company went belly up, so to speak, the answer is yes. You would be collecting from the insurance company. And for sure, if it's an individual company, which has nothing to do with the your corporation going belly up.
So if it's an individual policy, it would
either way, you would
still be in good shape.
Yeah, definitely for good shape. But either way, you would continue to collect. However, that being said, be careful on the definition of total disability. After a certain period of time, and I'm going to go over some of the definitions before we wind up today, the definition could change to one that's very restrictive, and you may not satisfy that definition. So if you are unsure about your definition, send me an email, and I'll give you some feedback accordingly.
Okay. That's all the questions we have now for the moment. Did you want to cover some more definitions at this point?
Okay, just to fill in the time so you get your money's worth, I will go over some definitions. One is the pure OC definition of total disability, which means it has no thereafters, no modifications or splits, and it simply says if you can't do the duties of your occupation, even though you're working in another occupation, making more money, you're still paid, okay? A split definition has 2 parts to the split, meaning its own OC and not working elsewhere, which means it's the claimant's choice. If they work elsewhere, then the definition has been violated and they may not be paid, okay? Split simply says own OC and unable to work elsewhere, which gives the carrier control of the claim. Because if the carrier feels that they can't do the duties of their occupation and are able to work in another based on training, education, and experience, the claim may be rebutted. Okay? Modified own OC, that's something you may have heard. That's pure own OC for a period of time, could be for 2 or 5 years, thereafter not working elsewhere. And once again, I could send you a summary of all the definitions. Modified own OC could be, again, own OC for a period of time, 2 to 5 years, thereafter unable to work elsewhere. Now, transition, that's a new definition that came about a couple of years ago. It basically says that as long as somebody's not making more in their new occupation compared to their income before, then the full benefit amount will be paid. If they're making more in excess of what their earnings were when they took out the policy, then the benefit amount will be reduced. That's called a transition. It sort of lets somebody transition and sort of becomes whole again.
And we're going to transition to another question. Can I receive a DI benefit if the claim occurs while I'm no longer earning a paycheck?
If you have an individual policy, the answer is yes, and if it's an own OC definition, the contract says that you'll be paid, let's say, $5,000 a month. It didn't say if you'll be paid $5,000 a month so long as you have no income or that you do have income. So the answer is yes, and I'll give an example. There's been claims paid where somebody has retired, kept their policy, became I don't want to say a housewife, that's maybe politically incorrect, but somebody who took care of the household and broke their leg and couldn't do the duties of whatever household person does, and they were able to collect. So the answer is, generally speaking, yes, depending on the definition. And being an individual policy.
Great. We'll pause to see if there's any more questions. And one question. If the person changes his job, does he have to declare this to the insurance company?
All right, that's a good question. Once a contract, and I emphasize it's a contract that's guaranteed renewable and non-cancelable, the contract cannot be changed. So even though, I'll be facetious, somebody was a CPA and they decided to become a musician, and that's happened a couple of times. I've had a couple of cardiologists who were fed up with doing their occupation and became a musician, and they couldn't do the duties of a musician. They were still paid because the contract is ironclad. Nothing in the contract on an individual policy can be changed so long as it's guaranteed renewable and non-cancelable.
And another question, if you're new to selling DI, so during a meeting with a life insurance client, this would be definitely an appropriate time to cross-sell. Is that correct, to bring that up?
Absolutely, sure. Sure. Great. Although I might add a little bit to that. In terms of selling, you have to know your client, of course. If the primary purpose, and you've sold the purpose of life insurance is to protect the family, and they're marginal in terms of being able to afford the life insurance, you may not want to sink the ship with another expense, okay? Walk out with one product under your belt, and then maybe as their income goes up and they become used to paying that premium, then maybe go back. But I would certainly talk about it for reasons of due diligence.
So you're introducing the concept, even if you're not going to close the sale for both in that meeting.
Right. That circumstances has to be perfect to ask for two premiums.
Exactly. Great. And we'll pause to see if there's any more questions that our audience might have. And we are getting towards the end of the presentation. Any more? Well, we do actually have another question here. I have a DI buy-sell, became disabled, and I'm being paid out of my monthly benefit, but the company I owned now goes out of business. Even though I haven't received full value, will I still be paid?
Okay, I think that's a question similar to before. What happens if in a group plan, if the company goes out of business, will I still be paid by the carrier? As long as the claim has been approved in a buy-sell agreement, then even though the company went out of business, I'm going to hedge a little bit because I don't have all the facts, but it appears that I will stand by what I said. You will be paid if the policy was enforced, there were no exclusions, you satisfied the elimination period, and so on. So you should be paid, and I'm just hedging a little bit because there may be more facts to what your question embodied.
What about mentioning business overhead with DI?
Absolutely, because business overhead, simply because the benefit period is usually short, 12 months, and I would definitely mention it with DI. Again, if it's a marginal sale, meaning that you're focusing on individual and the additional premium, even though it's a tax deduction, might sink the ship, I would maybe just present it, let the prospect know that it's available, and you've done your due diligence.
Is all group DI integrated with Social Security?
I would say 99.9% yes. There's always the one exception. And
to determine that exception, look at the fine print of the policy.
Exactly.
Okay, excellent. If you have a group STI through an employer and an individual STI, how would payment of benefits work?
Well, you would collect from both, because if the group plan, and this is going to bring up an interesting sidebar, if the group plan was there first, and because the benefits are taxable and you applied for an individual policy, the carrier that supplies the individual benefit amount will look at how much you have in front of them and only issue a certain amount. Conversely, if you had an individual plan first, before any group plan came aboard, then you would collect from both unless the group plan specifically excluded income from other individual plans. So always try to get your client to get individual insurance first, and then if group has to be added on, so be it. The group carrier is kind of stuck with that kind of an arrangement. Good question.
Great. Well, we are almost out of time. Any final thoughts, Larry?
No, that's, I think we covered it. I just want to summarize. If anything I said as quickly as I said it, you need some specific information. You don't have to buy the encyclopedia. I have a list. I have all my articles in Word. I could send you any article that you think is appropriate. When is the best time to get disability insurance? How to select the ideal disability policy, et cetera, et cetera.
Great. And if you are interested in contacting Larry regarding the Disability Insurance Encyclopedia, which I understand is 2 volumes, is that correct? Okay, so a very thick book. You can do so by contacting info@diresourcecenter.com. There's a hyphen after DI and a hyphen after resource, but you don't have to remember that because I went ahead and sent that to you all in the chat box. So you can go ahead and take a look at that. And in addition, if they were to simply Google DI Resource Center, they could probably get a hold of you too, couldn't they?
In fact, yeah, there's lots of stuff out there on me.
Outstanding. Well, I want to thank all of you for participating on the webinar today. And I also want to thank Larry Schneider for sharing his time and expertise with me. We're broadcasting right here live together in the same room from NAPA headquarters, so thanks so much for stopping by today, Larry, to take time with us. And this concludes the NAPA webinar.